With us today is Andrew Feltus, Senior Vice President at Pioneer Investment Management, and he's here to share with us his views on the global high-yield bond market. Hello, Andrew. Thanks for joining us. So, entering the second half of 2012, what's driving global high-yield bond performance?
Well, you still have the risk-on, risk-off dynamic, and the problems out of Europe seem to be swamping everything else. I don't expect to see those problems go away, but as they're addressed, we should see better performance out of risky assets. And risky assets have widened out over 700 basis points over for high yield now. That sets us up for a much stronger second half than we had in the last quarter.
Do you think the problems in Europe are likely to be long-term? And what further risks are we seeing amid a still challenging macro backdrop?
Yeah, well, I think Europe is the number one risk to the market. I mean, there's problems with how the euro is constructed, and until those problems are solved, those problems don't go away. Now, that doesn't necessarily affect the U.S. or the emerging markets, but it does affect everybody's markets. The problems do have solutions. I think things like an easier ECB, a banking union, and ultimately a fiscal union would address a lot of the shortcomings of the euro. But it's a political process, and it will take time to get to those problems. So I think what will happen is we'll have 3 good months, we'll have 6 bad weeks. We'll have 3 good months. What you want to do is find good assets, and when the market allows you to buy them at attractive prices, because of Europe, that's a great entry point.
Okay, so within the high-yield space, which markets and sectors are likely to outperform?
Well, we prefer U.S. high yield and we prefer emerging markets. U.S. is growing slowly but steadily. And I think if you have a situation where the market gets concerned, the Fed will execute QE3, and that puts a floor on how bad high yield can get. Emerging markets, likewise, a very strong backstory. That's where you're going to see the bulk of global growth going forward. And growth is the most important thing for high yield investing. The caveat there is that not all emerging markets are the same. You have to look at each country, each company, and understand what you're buying and make sure you're buying at the right price.
And which markets or sectors will you avoid at the moment?
Well, Europe clearly is the biggest problem. But in general, we're comfortable with the growth environment on a global basis, which means that most sectors are fairly well positioned. Even sectors like retail should continue to improve. Those are traditionally weaker sectors, but as the U.S. consumer ends their deleveraging, that should benefit. I think you have to be more focused now on avoiding bad companies than necessarily bad sectors.
As investors are still fearful of the volatility in the markets, what downside are there in the global high-yield markets, and how would you advise them to allocate their portfolios?
I think the first thing is that the volatility is not going away. The thing, though, is volatility is not the same thing as risk. To me, risk is permanent impairment or defaults, and we're in a very low default environment. So the nice coupon that you earn by investing in high yield will help smooth out those ups and downs over the medium term. So if you really are concerned with a recession, both in the U.S. and on a global basis, you don't want to be involved in high yield. But if you're not concerned with that, these sell-offs are great entry points. And that's how I'm looking at the most recent backup. You now have a situation where you can earn, on average over the next couple of years, 7 to 8% in the high yield market. That's very favorable compared to treasuries and very favorable compared to equities as well. So that's a very good entry point.